Hi, it's Kevin Schumacher with the Kevin Schumacher Team here at eXp Realty with your April market trends. So let's talk about the market. It's been sort of a wild ride, which no one would have forecasted. We came out of January reporting record numbers, the strongest January we've had in decades when it comes to sales, and we were anticipating we were going to have record-breaking numbers all the way through first and second quarter. Then the pause button was hit. So what does that mean? The big question is where's the market going? Are we going into a recession? We've talked to a lot of national economists and people that we consult with. We've dove into the numbers, trying to look at where we're at today, what's the pending sales, where are they going, where's the projections going. One of our national economists and consultants put it like this. He said, Kevin, it's like a tornado. In 2008, we had this tornado that blasted through when we had the mortgage meltdown, and it took out our infrastructure. It took out mortgage companies. It took out all kinds of real estate related vendors and businesses. And then there was a trickle down effect, the ripple down with that went into people that weren't buying cars. They weren't frequenting their favorite restaurants, and it impacted everybody. And where you look at where we are today, it's almost like they push the pause button and we have a snow day, but it's a blizzard. And people are being affected, there's no question, but our infrastructure in general is still there. Now, the longer it goes, the more people are going to be impacted, the more businesses are going to be impacted, which is why there's the urgency to get the economy back up and going. And I think that everyone acknowledges that, and we also feel our hearts go out to those that have been affected by this horrible pandemic and so forth. When we look at the last 5 recessions that we've had, two of the last five were there was a negative. It impacted the values of real estate negatively. 91 with the Gulf War, which wasn't quite as significant as a negative impact, but obviously 2008, where it was, I think, a 19% drop in values. And again, that was because it was so real estate related. When you look at building up to in 2008, when you look at the appreciation, how it built up in 2008, it was fairly rapid. So people will continue to see all this growth and appreciation and equity versus when you go back and you look at where we've been growing on national scale and national numbers, it's been more of a gradual increase. Now, areas like the Colorado Front Range, we have had more aggressive appreciation, and a lot of that's due to the whole supply and demand and such low inventory and living in such an amazing place. We have a lot of people that are moving into our area still. So when we go back to the home equity piece, we look at the 3 years prior to 2008, there was over $800 billion that was cashed out where people were taking equity out of their homes and using it as like an ATM machine and living off of it. Or maybe they were reinvesting and buying other property. They were going on trips, whatever it was, versus the last 3 years of leading up to today, we've had a little over 200 billion of people that have taken equity out of their home for whatever reason. So we're looking at 25%, 75% less than what it was prior to the 2008. When we look at currently equity positions, over 37% of the homes that are out there are paid for. Of the homes that are out there that have mortgages, 26% of those homes have 50% or more equity. So when you look nationally at all of the homes out there, that means over 53% of the homes out there, people are in a equity position greater than 50%. So again, we're positioned in a better position, and again, we have better infrastructure today than what we ever have in some of the other recessions, which is why they believe we're going to come out of this much faster. When you look at projections of unemployment, obviously there's big numbers. The most recent unemployment numbers are getting ready to come out, so we don't have those for you yet. But when we look at projections, we looked at some of the different big companies and banks that were out there, and Goldman Sachs is probably the most conservative in their numbers, and they're guessing that once the play button is hit with the economy, we're going to level out at about 15% unemployment, and then next year we'll be sort of at 6 to 8%, and we'll continue to see a downward flow and downward trend from there. When you look at the pool of unemployment right now and those that are applying for unemployment, almost 60% of the people based on the last reporting, almost 60% of those people are in the restaurant business, hotel business. And so there's now, when the play button is hit with the economy and we're back up and running, guess what? Those employers are going to be calling their previous employees and saying, guys, come back to work. We need you. We've trained you. You're loyal and we want you back. So again, will some people be affected? Will they have less hours? Most definitely, we get it. But again, those numbers are going to go down dramatically. A lot of businesses hopefully are going to be able to benefit from the stimulus package that's out there as well. When you look at historic pandemic recessions and what the numbers look like, a lot of the economists reference what they call a V curve. So you have a drastic drop, sort of like the pause button in the blizzard, and then the play button hits and the economy cranks back up because, again, you still have in general a solid infrastructure. That's what they're projecting here, is a rapid increase in growth and hopefully getting back to normal as quickly as possible. So let's sort of look at where we forecast and where we're going. And again, a lot of these are just sort of looking at the 27 years I've been doing this, as well as talking to other people in the industry and really trying to look at our current inventory and so forth. Prior to the pandemic, we were sitting in the Denver metro area about 25 days inventory, meaning if not one home hit the market in 25 days, they'd be out of inventory. Normal market, 5 to 6 months. Okay, they're sitting somewhere around 35 days inventory, something like that, where the Colorado Front Range, northern Colorado is more like 45 to 50 days. The one thing that's still happening is that there was a lot of new construction starts for the spring market, and they're still being built and being completed, where we see the amount of resale homes that are hitting the market, those numbers have dropped some, and people are sitting back going, okay, what's going to happen? Short term, again, inventory going on, it's sort of stagnant. There's hints and talks about when the economy is going to go back, and open up sometime in the beginning of May and have a transition period. We're already starting to see a lot of inquiries, and clients are saying, okay, Kevin, we have to sell we have to sell, or we want to sell and take advantage of buying in low interest rates this summer. So whether it's 90 days, 120 days, or even 6 months, so they're looking at how can we position ourselves? What can we do to get ready? We're telling them, take the time now while you have it and do all of the little projects that you didn't have time for, whether that be freshening up in paint, whether that be decluttering, packing seasonal things up, as the weather continues to get nicer, preparing the lawn and the yard, and so everything is ready to go. Because don't forget, we still have a good chunk of new construction inventory that's out there, and buyers are going and looking at that and looking at a brand new property that's going to be staged and ready to go. And depending on the inventory and how the inventory hits, I believe there's going to be a surge of new inventory that's going to hit. And now, depending on how big the buyer pool is, which was fairly significant, depending on how big and how those compare, we may see a little flattening in prices short term. And then when you have a flattening in prices, then the sellers, those who want to sell or need to sell and have to sell, will get aggressive in their pricing. You'll start seeing more builder incentives, lender incentives that are working with builders and so forth to make them stand out and be the obvious opportunity for buyers that are out there. So again, my advice as a seller, get ready to go. We have a lot of e-guides that talk about different prep work and things that you can do to get your home ready, or obviously you could always reach out to us as well. So when you look at the average sales price and below, that's still going to be a really strong market because we don't have much inventory out there, and there's definitely a large pool of people wanting that affordable piece. I believe when you get into the luxury market and the upper end market, I think that's gonna go flat. I think that it may even take a little bit of a dip. And the reason I say that is because there's been a lot of sellers out there and homeowners that have that upper end home in that luxury end market and said, well, if I get X, I would sell it. And people that are moving into the market and were motivated and needed to buy, they bought just because of scarcity. There was nothing else for them to buy. I believe that people in that market, buyers, I think they're going to sit back a little bit and watch and see where the economy goes. So again, that's why I believe there's going to be a little bit of a flattening, maybe some opportunities if you are a buyer in that market. I believe that by fourth quarter, you'll start to see that market come back, and we'll start to see values continue to appreciate, especially the ones that live in, especially luxury homes that have an amenity that you can't go and replace. So I believe that the rest of the year, and even going into early spring of next year, is going to be more of life event sales. What I mean by that is in the 27 years I've been doing this, one thing has been consistent is there's life events that happen. People will get divorces, and there'll be a forced sale. So there's a division of equity, and they can go on with their life. There'll be people that are going to outgrow their home because they came home with twins or triplets, and they just need more space. There'll be people that have been renting for a period of time and tired of paying $1,200, $1,500, $2,000 a month in rent. They're going to want to buy. And then there'll also be estate sales of people that passed, and they need to distribute the allocation of the estate. Life events will happen. They'll continue to happen. They've always happened in good markets and bad markets. So I'm confident that obviously that trend will continue. So what I would say is if you're looking at selling and you want to take advantage and get top dollar, watch out for our reports that we put out there, the e-guides. But do the spring cleaning, hit the yards, getting things ready to go. The market will come back. The market will be strong. Our hearts definitely again go out to all the people that have been affected in our area and will continue to be affected. So please stay safe. If there's anything we can do to help you, especially small businesses that are out there, we definitely are a resource where we can provide information and resources that are out there to help you as well as homeowners. So again, be safe. And if there's anything we can do, please let us know. You can always find us at kevinsellsco.com or you can reach us at 720-230-3030.